Welcome to the International Rescue Committee's video series on buying a home in the United States. This video is divided into 3 parts. Part 1 will go over how to make a financial plan and determine what you can afford. Part 2 will go over how to finance your home purchase, including mortgages and other resources. And Part 3 will discuss shopping for your home. In this section, we'll focus on a few key objectives. First, we'll break down the mortgage process and what you need to qualify. Next, we'll compare different types of mortgages so you can choose the option that fits your budget and goals. We'll also look at the key costs involved, like principal, interest, and mortgage insurance, so you understand what makes up your monthly payment. Then, we'll explore programs for first-time buyers and alternative financing options that can make homeownership more accessible. Finally, we'll cover how to find the right lender and get pre-approved, so you're ready to move forward with confidence. The home buying process has several key steps. It starts with getting pre-approved by a lender, which helps you understand your budget and shows sellers you're serious. Next, you'll shop for a home, tour properties, review listings, and work with your agent to find the right fit. Once you find a home you love, you'll make an offer and negotiate terms with the seller. After your offer is accepted, you enter the due diligence phase. This includes inspections, appraisals, and resolving any issues before moving forward. Then comes pre-closing, where repairs are confirmed, funds are prepared, and final paperwork is reviewed. Finally, you'll close on the home, sign documents, settle costs, and get the keys to your new property. What is a mortgage? A mortgage is a loan you take to buy a home. You agree to pay it back with interest over time. Most mortgages last 15, 20, or 30 years. If you choose a longer loan, like 30 years, your monthly payment will be smaller, but you'll pay more in interest overall. A shorter loan, like 15 years, means bigger monthly payments, but you'll pay off the home faster and save money on interest. Each payment has 2 parts: the money you borrowed, called the loan amount, and the interest, which is the cost of borrowing. At first, most of your payment goes to interest. Later, more goes toward paying off the loan. To get a mortgage, lenders look for a few key things. First, they want to see steady work, usually 2 years in the same type of job. Next, your credit score matters. Most lenders need a score of at least 580. You'll also need some savings for a down payment and enough income to afford the monthly payments. Lenders check your rental history and your debt-to-income ratio. This means they look at how much of your income goes toward paying debts. The lower that number, the better. In short, steady job, good credit, some savings, and a budget that works. There are several types of mortgages, and each comes with its own pros and cons. You don't need to memorize every detail, but it's important to understand the basics so you can choose the option that fits your needs. Fixed-rate mortgages keep the same interest rate for the entire term, usually 15, 20, or 30 years. The benefit is predictability, but if market rates drop, you could end up paying more. Adjustable-rate mortgages start with a lower interest rate, which can make them attractive initially. However, after a set period, the rate can change, meaning your payment could go up if interest rates rise. FHA loans are backed by the Federal Housing Administration and help buyers who might not qualify for a conventional loan. They allow for lower down payments, but the loan amount may be limited. VA loans are for eligible veterans, active duty personnel, and surviving spouses. They often offer competitive rates and require little or no down payment, though the size of the loan may also be limited. The key takeaway: each mortgage type has advantages and trade-offs. Compare your options carefully and think about your long-term financial goals before deciding. When you choose a mortgage, you'll often decide between a fixed rate and an adjustable rate loan. A fixed rate mortgage has an interest rate that stays the same for the entire loan. This makes it easier to budget and protects you from sudden changes in rates. The downside is that if rates are high, it can be harder to qualify. An adjustable rate mortgage starts with a lower interest rate than a fixed rate loan, which can save money in the first few years. But the rate can go up or sometimes down later, which means your monthly payment can change. This makes it harder to predict your costs. In short, fixed rate gives stability, adjustable rate offers lower initial payments but more risk over time. Every mortgage payment you make includes 2 main parts: principal and interest. Principal is the amount you still owe on the loan, the balance you're working to pay off. Interest is the cost of borrowing money, the amount you pay just for having the loan. While your total monthly payment for principal and interest usually stays the same, the way it's divided changes over time. At the beginning of your mortgage, most of your payment goes toward interest and only a small portion toward principal. For example, if $1,000 goes to principal and interest, early on about $700 might go to interest and $300 to principal. As you keep making payments, your principal balance decreases. Since interest is calculated as a percentage of that balance, the interest portion gets smaller and more of your payment goes toward principal. If you make extra payments toward principal, especially early in the loan, you can reduce the total interest you pay and pay off your mortgage faster. If you do not pay 20% of the purchase price as a down payment, you will be required to pay mortgage insurance. This is an insurance policy that guarantees the lender will recover their investment if you stop making mortgage payments. The lender will still take your home from you and sell it. Mortgage insurance does not protect you in any way. You can sometimes buy out the mortgage insurance when you are first getting the loan, or else you will have to pay it each month. Mortgage insurance typically costs between $100 and $300 per month. Once it eliminates your monthly mortgage insurance, it will decrease by the amount you are paying for mortgage insurance. First-time home buyer programs are designed to make buying a home easier and more affordable. These programs often include government-backed loans offered by approved lenders. They usually have lower credit score requirements and allow smaller down payments, which is helpful if you don't have a lot saved. They also accept higher debt-to-income ratios, so you can qualify even if you have more existing debt. One common option is an FHA loan, backed by the Federal Housing Administration. FHA loans are great for buyers with lower credit scores and limited savings because they only require about 3.5% down. However, they can only be used for a primary residence and come with mortgage insurance costs. Another option is a USDA loan, which is designed for homes in rural or some suburban areas. USDA loans often require no down payment at all, but you must meet income limits and choose a home in an eligible location. There are some limits, like how much you can borrow, and these loans often come with higher insurance costs. To qualify, you'll need a minimum credit score, a reasonable debt-to-income ratio, and steady employment, usually at least 2 years in the same line of work. First-time homebuyer programs are designed to make buying a home easier and more affordable. These programs often include government-backed loans offered by approved lenders. They usually have lower credit score requirements and allow smaller down payments, which is helpful if you don't have a lot saved. They also accept higher debt-to-income ratios, so you can qualify even if you have more existing debt. There are some limits, like how much you can borrow, and these loans often come with higher insurance costs. Examples include FHA loans, USDA loans, and other government programs. To qualify, you'll need a minimum credit score, a reasonable debt-to-income ratio, and steady employment, usually at least 2 years in the same line of work. A mortgage is likely the largest financial commitment you'll make in your lifetime, so it's critical to understand the terms before you sign. A good mortgage should have certain features that protect you and your finances. Look for low interest rates, a fixed interest rate rather than one that changes over time, relatively low fees, terms that are clear and easy to understand, no penalties for paying early, no hidden or extra charges, no balloon payments, which are large payments due at the end of the loan. If anything about your mortgage seems unclear or doesn't feel right, please talk to your lender or reach out to me before agreeing to the loan. Making sure these conditions are met will help safeguard your home, your family, and your money. When you're choosing a mortgage, it's important to make sure it fits your financial situation and long-term goals. Let's start with the loan term. A loan term is the period of time over which the loan will be repaid. Common terms are 15, 20, or 30 years. The shorter the term, the faster you'll pay off the loan. This means you'll pay less in interest overall, but your monthly payments will be much higher. On the other hand, a longer term lowers your monthly payment but increases the total interest you pay over time. Next, look at the interest rate. Is it fixed, meaning it stays the same for the life of the loan, or variable, which can change over time? Also, pay attention to the actual percentage rate. It will directly affect your monthly cost. Finally, ask yourself 2 key questions. What will my monthly payment be? Can I realistically afford this every month? Choosing the right mortgage isn't just about qualifying, it's about making sure the loan works for your budget and your future. Some homebuyers choose Islamic financing options, which avoid interest-based loans. There are 3 common models. Musharaka. This is a co-ownership arrangement between the buyer and the financing company. Both parties invest in the property and purchase it together. In a version called diminishing musharaka, or the declining balance method, the buyer gradually buys out the financier's share while paying a fee to use the property. Ijara. This works like a lease-to-own agreement. The financier buys the property, and the buyer rents it. Part of each payment goes toward eventual ownership. The property is not registered in the buyer's name until all payments are complete. Murabaha. In this model, the financier purchases the home and resells it to the buyer at an agreed-upon profit, with payments made over time. The buyer pays a deposit and then makes regular payments that include the profit margin. This is not an interest-based loan. It's a resale with a deferred payment structure. When you're ready to get a mortgage, the first step is finding the right lender. You have several options: national banks, large institutions like Bank of America, Chase, or Wells Fargo. They often offer a wide range of mortgage products and have strong online tools. Local banks, regional banks such as Zions Bank or Virginia National Bank. These can provide more personalized service and may have competitive rates. Credit unions, member-owned organizations like Mountain America FCU or Bethpage Credit Union. They often offer lower fees and better rates for members. Mortgage bankers, companies like Rocket Mortgage or PHH Mortgage, specialize in home loans and can streamline the process. Mortgage brokers. Brokers don't lend money themselves but work with multiple lenders to find the best mortgage option for you. Each option has pros and cons, so consider what matters most: personal service, convenience, or the lowest possible rate. When you apply for a mortgage, lenders provide different levels of certainty about how much they're willing to lend. Here's what each step means. Prequalification. This is the lowest level of certainty. It's an estimate of how much you might be able to borrow based on basic financial information, like your income and current debts. No credit check is required at this stage. It's useful for getting a rough idea of your budget. Pre-approval. This is more formal and often required by sellers before they accept your offer. The lender reviews your credit score, income, and assets to commit to lending you a specific amount. Pre-approval shows sellers you're a serious buyer. Approval. This happens after your offer is accepted. The lender conducts a full review of your finances and orders a home appraisal. This step involves the most paperwork and confirms the exact mortgage for the specific property. It's smart to shop around before choosing a lender. Different lenders offer different interest rates and fees, and those differences can add up to thousands of dollars over the life of the loan. For example, when I refinanced my home, I found a $5,000 difference in fees and a 1% difference in interest between two lenders. That 1% could mean tens of thousands of dollars over time. One more tip. When lenders check your credit, it can lower your score by about 5 points per inquiry. But when you're shopping for a mortgage, all credit checks within a 30-day window count as one inquiry. So, you can apply with multiple lenders without hurting your credit. At the pre-qualification stage, you should be able to get rate and fee estimates without a credit pull. Just make sure you confirm this before sharing personal information like your social security number. When you're starting the home buying process, you'll hear two terms: pre-qualified and pre-approved. They sound similar, but they mean very different things. Pre-qualification is the first step. It gives you a ballpark estimate of how much you might be able to borrow based on basic information you provide, like income and debts. It's usually free, can be done online or over the phone, and doesn't require a credit check. However, it doesn't carry much weight with sellers. Pre-approval, on the other hand, is much stronger. It provides a definitive amount you can borrow and includes an interest rate. To get pre-approved, you'll complete a mortgage application and submit documents like proof of income and assets. This process gives the lender a clear picture of your finances and speeds up the buying process. Sellers often require pre-approval before accepting an offer. In short, pre-qualification is a quick estimate, while pre-approval is a formal commitment that makes you a more competitive buyer. That brings us to the end of Part 2 of the International Rescue Committee's video series on buying a home in the United States. We explored the key steps in preparing for homeownership, such as understanding mortgage options and finding the right lender. In the final part of this series, we'll cover the exciting part of the home buying process: shopping for your home.